Let me give you just, let me start with the story as to why I think you should consider the bond markets in China. And not just in China, but more broadly in Asia. And let me put one thought into your mind that the main reason is that broadly, the governments of the West are bankrupt, they are insolvent, and governments in Asia are broadly solvent. Now, why do I say that? It's not because of debt to GDP, it's because of liabilities to GDP. If you listen to someone like Bill Gross thinks that the liabilities of the US government are about $100 trillion. Now, GDP is about 16, 17 trillion. We all know that debt to GDP is about 100%. So of those 100 trillion liabilities that the US government has, only about 17 are funded. That's leaving over $80 trillion of unfunded liabilities. Liabilities to GDP is of the order of 700%, and similar numbers for countries like the UK. Now let me give you a practical example of the UK, my home country. And let me introduce you to two ladies in my life, which some of you might be surprised by, but there are two. One is my mother. God bless her, she's 84 years old, and she lives in London, and I'm based in Asia. My family live in KL, and I work in Singapore. Thanks to Aberdeen, I get to go to London reasonably frequently, and every time I go to London, I do a couple of things. First of all, I go and see my mother, and I always say, "Mum, how are you?" And she says, "Oh, Don, I'm fine, thank you." And I always say, "Mum, is there anything I can do for you?" And again, she says, "No, thanks, I'm absolutely fine." Now, the reason why she is fine is because she receives a state pension from the UK. She's been receiving a state pension from the UK government for the last 24 years, since she retired at the age of 60. And not only does she get a state pension, she gets free healthcare courtesy of the National Health Service, she gets free trains and buses with her granny pass, she gets a free TV license, and when it gets a little bit cold in winter, she gets a free winter fuel heating allowance. There is literally nothing that I can do for my mother apart from buy her some flowers on Mother's Day and maybe a box of chocolates on her birthday, something like that. So the second thing that I do is when I go into the Aberdeen office in London is I make a point of going around all the desks and thanking my colleagues for paying so much tax so that my mother can live in such comfort without me paying a penny towards her expenses. It's not because I don't love her, she just doesn't need anything. At least that's what she says, but you know, in this internet age, who knows what little old ladies get up onto the on the internet. She tells me that her days of sex and drugs and rock and roll are all over. So let me introduce you to the second lady in my life, and this is a little Chinese lady who happens to be my mother-in-law who lives in Kuala Lumpur. She's 74 years old, and in terms of the amount of money she gets from the Malaysian government every year, it is a very round number. It is nothing. Now, it's partly because she's ethnically Chinese rather than Malay, so there is a sort of, to be frank with you, there's a slight racial element to the story, but it's a good metaphor nevertheless for what's going on in the region. But basically, as her eldest and best paid son-in-law, I am her social security system. The house that she lives in is the house that I had the privilege, the honor to go and buy for her. And when it needed repairs, she moved in with my family so that I could pay for the plumber, the plasterer, the electrician to go and have it repaired. I pay her a monthly allowance so that she can put food on the table for her family, and when she gets sick, then I pick up the bills. Now that is social security Asian style. So as investors, when thinking about the globe, you have a choice. You have a choice of lending money to essentially bankrupt governments in the West or lending money to more solvent governments in Asia. And of course, in a country like Singapore, they have a system very similar to yours here called the CPF, the Central Provident Fund, to which everyone contributes. They have EPF in Malaysia, MPF in Hong Kong, and when I was at a similar conference in Hong Kong a couple of years ago, I was told, much to my surprise, that actually the CPF in Singapore, the EPF in Malaysia, was not set up by some clever Chinaman like Lee Kuan Yew. It was actually set up by the British before we left. It is Britain's greatest ever export and it is so sad that we have no equivalent in the UK. My mother's pension is paid out of tax revenue. There is no pot of gold that the British government has. And as you all know, because you may have participated in it, the British government has actually just sold off the last of its trophy assets, the post office. So when you then throw in the low levels of yields in the G7 bond markets of the world, 50 basis points on 10-year JGBs, 1%, barely that, on 10-year bunds. The biggest joke of all, of course, is the 2.5% you're paid to lend money to the Italian and Spanish governments for 10 years, let alone 2.5% for 10-year US Treasuries. There's not a whole load of value in those bond markets, and there's not a whole load of quality either. So that's a little story just to set the scene for what's going on. Let's switch to Asia. And what's happening in Asia, basically, is that we are in the midst of the mother of all mean reversion trades. If I could show you a slide of a 2,000-year history of global GDP, then up until the year 1800, India and China were the center of the world. McKinsey have a chart that's rather elegant that puts the center of the world economy in AD 1 at somewhere over Mesopotamia, Hanging Gardens of Babylon. And by about 1950, it's gone all the way west as the Industrial Revolution kicked in to somewhere in the middle of the Atlantic Ocean, halfway between Western Europe and North America. And of course, that's because the decline of Asia was enhanced by China's catastrophic embrace of communism and the horrors of the Mao era. And of course, India went under Nehru and Gandhi down this disastrous route of so-called socialism. And by 1950, India and China were statistically irrelevant from a global GDP point of view. Now, as we all know, Deng Xiaoping undertook his great southern tour in 1978 and started the reform process in China. And since then, China's never looked back. If you take India, obviously it took about another decade and a half for Manmohan Singh's reforms to kick in. But in terms of the center of global economic gravity today, we're probably somewhere over the Ural Mountains, heading rapidly eastwards. And if you believe people like Willem Bouter, who's the chief economist at Citibank, by 2050, Asia will once again be 50% of global GDP, and the center of economic gravity will be probably on the top of Mount Everest. And we're at about 30% of global GDP today. The result of this, and indeed one of the key drivers of this, is this surge in the numbers of people in Asia leading a middle-class lifestyle. And I think Gerard's already referred to that with the trip that many of you took up to China. But just to put some numbers on what it means to be middle class, and if you define it as Homi Karas does, as having between $10 and $100 per day of disposable income, then in 2009 in Asia, there are about 525 million people leading a middle class lifestyle. By 2030, that's in just over 15 years' time, he estimates that there will be 3.2 billion people in Asia leading a middle-class lifestyle. 3.2 billion. Now, Gerard, you mentioned something about cities in China. I spent Monday and Tuesday, Wednesday in Melbourne and Sydney, cities with roughly 4 to 5 million people. In China today, there are already over 100 cities with more than 5 million people. And thankfully, one of the questions that didn't come up just now was try and name as many cities in China as you can with more than 5 million people. I'm sure most of us could get Beijing and Shanghai, but even I would struggle to get into double digits, let alone to get past the 50 mark. So in terms of what's happening in Asia, this rise of the middle classes is being led by urbanization. Ladies and gentlemen, urbanization in Asia is the most important thing that is happening on the planet today. And I think you all need to understand that when you construct portfolios. It doesn't necessarily mean that you have to go piling into Chinese or Asian bonds or indeed Chinese or Asian equities, but you have to understand this dynamic. It is the most important thing. It is more important than QE and whether or not the Fed decides to raise interest rates next year. It's being driven, and I'm sorry I don't have it with me, by the mobile phone. The mobile phone has helped people bypass copper wires in the ground. You take a country like India, 15 years ago, only 3 in every 1,000 people in India had access to a telephone. And it was one of those old-fashioned Bakelite phones that you see in Hollywood movies in the 1930s. Anyone who's been to Mumbai, try to make a phone call, even within Mumbai. If you could get through, it was like talking to someone on the moon. Today in India, just 15 years later, there are over 1 billion mobile phones in the country. Now, what do people in India use mobile phones for? Well, it's exactly the same that you and I use mobile phones for calling people, sending messages, sending pictures, and increasingly getting access to the internet. And of course, everyone in India, everyone across Asia, there are almost 4 billion mobile phones in Asia now. China Mobile, one company, has 800 million customers. We are witnessing the plugging into the global social, economic, financial, and political world that we inhabit of 3 billion people. The planet, the world, the financial system, all of us, we've never seen anything like it, and it's happening today in our lifetime. So just imagine there's a family right now moving with their suitcases somewhere in the middle of China, and they've decided to leave the village, and they're walking towards the local bus station or train station to take the bus or the train to the local Big Smoke. And let's say we could call them on their mobile phone and say, Mr. Zhang, do you know the Federal Reserve in the United States is going to raise interest rates next month? I think you should go back to your village. What are they going to say? Of course not. They're not going to give up their dreams of wanting to lead the sort of lifestyle that we all lead in the West because the Fed's going to raise rates. So this is incredibly important. In terms of giving you some stats on what's already happened, I mean, the changes in Asia are already dramatic. Take life expectancy as a measure of health. And for those of you who were at the earlier session this morning, we all heard about how much lower life expectancy is for certain communities in Australia who live out in this part of the country. But look at China. In 1960, life expectancy in China was 36 years. 90% of the room, of you, ladies and gentlemen, in this room would already be dead. People with grey hair like me would have been pushing up the roses for several decades. Today, life expectancy in China is 75. India, it's gone up from 42 to 66. And even a squeaky clean country like Singapore has shot up from 64 to 82. So there's already, if you multiply that by number of people, in terms of the number of people years that are being lived, this is, the India number, the China number is times 1.3 billion. And of course, Asia's getting a lot wealthier as well. China, GDP per capita has gone up from $76 50 years ago to $7,333 today. The extraordinary winner here actually is South Korea. South Korea at the end of the Korean War was one of the poorest countries in the world. GDP per capita was $60. It was poorer than Lesotho or Swaziland or Mozambique. Then a guy called General Park took over in a coup and transformed the country in 50 years from agricultural, rural poverty into G20 economic technological powerhouse, such that GDP in Korea has gone up from $92 in 1960 to over $25,000 today. We're almost at $26,000. And South Korea is actually the poster child for development in this part of the world. Now, I mentioned urbanization as the great trend. Let's look at these countries. We've already seen the GDP per capita by country. Let's go to the big cities. Let's look at GDP per capita not by country but by capital city or major city, and look at Shanghai. Shanghai GDP per capita is already over $20,000 per head versus a level in China of about $7,000. Taipei is already over 40,000 compared to a country that's barely at 20,000. KL, where I live, 25,000 versus the national level of about 11 or 12. So it's no wonder that people want to move into the cities, because that's where the wealth is and that's where the better lifestyle is. That's where you've got a chance of getting your kids educated in a decent school, and if you get sick, you can get yourself to a decent hospital on the back of a motorbike or on a car, or even, in some cities, in the back of an ambulance. And I put Sydney and Australia up there because, of course, Sydney's the exception that proves the rule. Of course, a lot of the wealth in Australia is not in the big cities, it's in the countryside because of the type of economy we have here. But the other interesting point is to say that these numbers are pre-tax. And I'm afraid the marginal tax rate in Australia is, as I understand, 40, 48%, something like that, whereas in Hong Kong or Singapore it's 15 or 20. And if you look at these numbers on an after-tax basis, then basically cities like Shanghai, KL, Seoul, and Taipei are on a very similar level to Sydney. No wonder then that last year, 100 million Chinese went overseas last year for a holiday. Chinese tourism was up from 5 million visitors overseas 10 years ago. That still means there's 1.2 billion people who haven't yet come over and discovered the wonders of Australia. In terms of the opportunities for you, as I mentioned earlier, it doesn't mean all this that you have to start allocating to Asia. But what I would say is that, first of all, China has an enormous reform agenda under Xi Jinping. He's actually hugely popular because of his anti-corruption drive. And financial reform in China, and I'm sure Mike will talk about the through train that's coming between Hong Kong and Shanghai. China is opening up. The introduction of the renminbi into the global financial system is going to be as important for Australia and the world as was the launch of the euro a decade or so ago, and I hope it's going to be a lot more successful. But this slide gives you some idea of the reform agenda, plenty of challenges, and in a nutshell, I know there was a lot of debate about China yesterday. Is China going to collapse and have a Lehman moment? Our answer is very unlikely. The government has enormous resources, $4 trillion worth of overseas assets, and companies in China are called state-owned enterprises because they are owned by the state. So they've got plenty of assets, plenty of ammunition to deal with the challenges they face. The other point I want to make is that Asia is not just about China. 90% of the debate in the press that we have about Asia focuses on China. India is a bigger and better opportunity. It has rule of law, it's already democratic, it has a vibrant bond market, and it has a brilliant new leader in Modi, and importantly, an awesome governor of the Reserve Bank in this guy called Rajan. If he moves India towards inflation targeting and India starts getting inflation under control, incomes for the very poor are going to shoot up and the discount rate for equities is going to collapse. So please, don't just think about China, think about India as well. And I could go on about Indonesia as well, but I've only got 40 seconds left. In terms of assets in Asia, the great opportunity for all of you is that Asian assets are cheap. Currencies are cheap, the bond markets are growing and investable, and yields are reasonable. If you buy a portfolio of Asian local currency bonds, you're getting a yield on average of about 4% for 10-year bonds, and real yields are positive. And if you cherry pick a little bit, you can boost that yield quite easily. What is also interesting, though, is that in the dollar bond market, Asian names trade very cheap. If you lend money through a bond to an investment-grade Asian name, you will be paid about 1% more than lending money to an investment-grade US name. And if you lend money to an Asian high-yield name, you will be paid about 3% more yield to maturity. Now, 1% and 3%, these are big numbers for similarly rated companies. And then when you look at equities, equities are also cheap. It's not expensive to get on this train. The only question then is, why are Asian assets so cheap? And that is because of what my colleague Dino has termed the ignorance premium. There is this view outside of Asia that China is about to face a Lehman moment, and therefore you don't want to touch China, and therefore you don't want to touch Asia, and therefore you don't want to touch emerging markets, and maybe you don't want to touch Australia. We think that view is wrong. If you take the property sector in China, which is obviously one issue that I'm sure many of you will have questions about, in China there are 95,000 property companies, property developers. It's probably true that you do not want to be lending money to or investing in the shares of the bottom 94,950 of those companies. But within the top 50, there's probably a handful, maybe, I don't know, 10, 20 names that people like Michael or my colleagues can find that you can invest in quite sensibly or lend money to and get your money back, and they'll make money for you as a shareholder. So China, from my point of view, or from Aberdeen's point of view, is opportunity rich. It's probably the biggest collection of mispriced assets today on the planet, with the exception of Western government bonds.
A quick introduction of myself. My name is Michael Chiu. I work at HSBC Global Asset Management based in Hong Kong, and I manage the China A-share fund as well as the so-called ABH blended Chinese equity funds for HSBC. Here, I think today is a very good chance for me to talk about what my view is regarding the Chinese market. But before that, I guess at the beginning of this session, we have done a very interesting survey regarding the audience preference about Chinese equity investment. In brief, I guess there are some 25% of the people that do not like to invest in China at all. And another 50%, even though they want to invest in China, they would like to choose it to do it in overseas market. Like from Apple, for example, they sell 25% of the iPhone to the Chinese. For McDonald's and Yum's brands, for example, they sell anywhere 25% to 30% of the sales are generated from the Chinese market. So if I can have access through this very well-governed companies listed in the developed market, why bother China? Apparently, that is a very heartbreaking news for me, who come all the way from Hong Kong to here to present a Chinese story. But at the end of this presentation, I hope I can help you to have a second thought about these kind of positions. Before I'm going to talk about the good story about China, let's address some of the investor concern first. The most prevailing investor concern that I have heard about so far is regarding two major sectors, the banking sector in China as well as the property sector. Now, first about the property sector. Of course, we have seen a lot of growth in the property sector in the past 10 or 15 years, and now every year China is selling 7 trillion close to even more than $1 trillion of new property to the market. So this is a mind-boggling number. A lot of people would question me, like, I know that your country has been growing at a very fast pace in the past 10 years, on average more than 10% GDP growth, mainly driven by, I think, before 2005, due to the opening up of the WTO, China has benefited a lot from the export. And since 2005 and 2006, with the renminbi starting to appreciate, the export started to slow down a bit. On the other hand, the infrastructure building started to pick up, and that is why we have seen the iron ore prices, coal prices have gone up so much in the past decade or so. Now, these kind of drivers, to many of the audience I know, are already in the past, and a lot of people are worrying about the overspending in this infrastructure spending and so on and so forth. To some degree, I agree with this kind of agreement, and this is why I think this kind of a 7 trillion of new building, new property development every year are more likely to come to a stable growth going forward, meaning we are already at a kind of saturation point. However, on the other hand, we also have to acknowledge that infrastructure spending is still a very important growth driver for China. So roughly 25% of the growth is still coming from property development in China. So the government will not be able to allow this sector to come down too much too quickly. what they will do is more likely to be a kind of muddle-through scenario. And for us, the implication as a fund manager is more about stock selection and picking the winners, as Donald has pointed out. One very interesting trend that I'm observing in the China property sector is how unconcentrated or the market share are so low between different players in the market. Donald has mentioned some mind-boggling numbers to you, more than 95,000. But what I can share with you is the biggest player in China right now, the company called China Vanke. Every year right now, they build 180 billion RMB of new property. If you divide that number by the 7 trillion of the whole market, their market share is only 2.5%. That is already the largest property developer in China. Not to even mention some of the smaller players. And this is why for me, at least in the property sector, I will not play too much emphasis on the overall market growth. However, I would still continue to pick the right winner, like China Vanke, 2.5% market share. If you go to Hong Kong, the largest one, I don't know whether you heard about Sun Hung Kai Properties, 20% market share. So I'm not saying that they will reach 20% market share anytime soon, but at 2.5%, I think the market are more likely to consolidate. And the reason for that consolidation, I guess, at least will be coming from 2 points. One is that these property developer in China, in fact, they are the beneficiary of the anti-corruption campaign in China. Everybody knows in the past, if you have a good relationship with the local mayor, you can get the land very cheap in the past. But now with the anti-corruption campaign in China, these kind of practices are no longer allowed. And all the lands basically are being tendered or auctioned in the open market. That actually will benefit the big players through the legitimate ways to gain their land. The second thing that Donald has also briefly touched on that I very much agree is the access to cheap capital, especially for the top 50 players in China. Now, the number can be very huge in terms of the borrowing costs for these companies, in particular for property development, where your debt-to-capital ratio can easily reach 70%. So whoever can gain the access to cheap capital will win the game. For big companies like China Vanke, if they borrow in the offshore market easily, they can borrow at 5% interest rate. Versus kind of very small developer in China, if they have to resort to the local trust market that many of you have heard about, they need to pay 15% interest rate, 1.5. So the differences, we are talking about 10% differences in the interest rate. And this is why I guess this is one of the major reasons why I'm looking for the industry consolidation will be a big theme for the property developers in China. Another big theme or big question mark many international investors will have is the China banking sector, and related to that, the shadow bankings in China. I think that would be a problem, and in fact, if you look at the government debts to GDP ratio in China, right now is around 20-something%. This number, I have to admit, it did not include the local government debts. However, if we look at what the China Audit Committee have done recently, the local government debt number, we are talking about roughly 10 trillion of that, RMB-wise, are borrowing from the local banks, and another 10 trillion will be coming from the form of trust and wealth management product that we have heard about. So if you add these 20 trillion of local government debts to the equation, the total government debts in China, including central government 20%, and roughly another 20% is coming from the local government, would put the China debts to GDP ratio at around 40%. However, I would argue that that is still way lower than what we are seeing in the developed world. More importantly, why I do not believe in a hard landing scenario in China, I believe is related to the fact that here we are only looking at the debt side of the equation. If you think about China as a company, this is on the liability side of your balance sheet. This is on the debt side of your balance sheet. However, on the asset side of the balance sheet, China has $3.7 trillion equivalent of FX on their balance sheet, on the asset side. It would be absolutely stupid for the Chinese leader not to think about how to use this money on the asset side to resolve their own problem and let the market to go into a hard landing scenario. The other reason why I'm thinking China should be still okay, let's look at the current account surpluses, for example, in China. Last month, we have just seen the historical high current account surpluses, and on average, in the last year, every month, China was generating $25 billion of current account surpluses, and every year they will have another $300 billion. That is one thing that I'm more positive. And on the fiscal deficit side, China is running at around 2% fiscal deficits. All these numbers come to mind doesn't suggest to me China is going to into a hard landing scenario. And last but not least, even if you only focus on the debt problem in China, keep in mind all these problems are renminbi denominated, local currency denominated problems. In fact, China did not borrow on a net basis from the rest of the world. It is a net lender of US dollar to the rest of the world. So under this kind of scenario, we have seen what the US has done, and then followed by Japan, and now in Europe, their central banks print money, quantitative easing. That was the way the developed world handled their local banking sector problem. And now, in the case of China, we are not even close to that point. And again, I would just let you think about that. If you are bearish on China, if you see some negative articles coming out from FT or CNBC tomorrow saying that China is going into a hard landing, think about how they would do with their $3.7 trillion US dollar of reserves, how that can happen when your current account is in such a big surplus and fiscal account is so is in such a good health. Now, we've talked about the market concerns. Let's move on more to the kind of economic growth. I know many of the people who I talked to in this conference kind of query about the GDP growth in China. I can share with you that actually the last time that I came to, the first time actually I came to the Outback was in year 2000 to see the Ice Rock, and that was very fun. That was more like 15 years ago. And of course, in the last 15 years, there has been a lot of development in the Chinese market. But I guess more importantly is what is going to happen in the next 15 years for investors sitting here. Now, the way I'm looking at that is, even though China GDP growth has been growing very quickly in the past 10 or 15 years, we are still coming from a very low base. Very low base means our GDP per capita in China is roughly $7,000 US GDP per capita. That compares to Australia here, for example. We are talking about 65,000, almost 9 times the number in China. Now, I know developed market will be a different benchmark for emerging markets. Let's think about some of the emerging markets, like Brazil, Mexico, and Turkey. Their GDP per capita are somewhere between 10 to 12,000 US dollars per year. If China continue to grow at 7% per year, from now for another 6 years till 2020, at year 2020, China GDP per capita would be around 11,000 US dollar. That means my expectation is that if China can continue to grow at 7% per year, in year 2020, China living standard can catch up with those like in Mexico, Turkey, and Brazil nowadays. So this is my basic assumptions. If China is really going to grow another 7% for another 10 years until year 2030, its GDP per capita would double again to 22,000, and that would roughly put China in line with the living standard of South Korea and Taiwan nowadays. So this is my assumption right now, and this is why I believe after all this growth, China is still coming from a low base, and this is why I believe the 7% GDP growth number may still be sustainable. And again, under this backdrop, if you share with what I'm thinking, I think right now, given the valuation is already quite cheap for the markets, and if China really can grow at like 7% GDP growth, together with maybe 3% inflation, then your nominal growth would be around 10%. And even if China do not re-rate in terms of their valuations, And if the corporate sector can grow together with the markets, then we are talking about safely a 10 to 12% return going forward. Now, of course, I've spent a lot of time addressing some of the concerns on the overall market. What will be the investment opportunities or the longer-term drivers for China? I think there will be two. I'm thinking about that very interestingly. Looking at China nowadays, there are quite some similarities between my market with the US market back in the 2008 when we faced the global financial crisis. Back then, if you remember correctly, there were a lot of concerns about the US banking system, even the US dollar standard. Of course, nowadays, no one questions about that. I think they could accomplish that for two major reasons. One is that the US dollar standard did not disappear, even with quantitative easing. Inflation in the US continued to be quite low. And I share the same feeling that China inflation could be also quite low in the next decade or so. Secondly, I think more importantly, even if you look at the overall US economy, it did not recover very broadly. But on the other hand, corporate USA has been doing very well because of the increase in efficiency and maybe paying dividends and so on and so forth. The same thing, I would argue, that is also happening in corporate China, where the Chinese company has suffered a lot in the past from the lack of efficiency, but going forward, we believe that will change. And one thing that is going to happen is the financial reform, where you can see there will be a new program to be launched called the Hong Kong Shanghai Stock Connect, which means global investor like yourselves, will be allowed to buy from the Hong Kong exchange, which is an international exchange, without any worry about the exchange rate or the settlement and so on, to gain access to the China A-share market. Before that, foreign investor could only buy shares through the QF system or RQF system. Right now, it's roughly 100 billion US in size, but I would argue that this plan actually started in 2006, and RQF started in 2012. It took them 8 years and 2 years to build up to this size. And right at the beginning, we will be talking about 50 billion. And the beauty of that is this quota, this Shanghai Hong Kong Connect quota, will be a transferable quota that institution A, if they want to sell the equities, then they can let the other institution to take up the quota right away. So this is why I think the market has high hope on this kind of reform. And later on, if I have time, I can further elaborate. But anyway, I think this is one of the financial reform under what the government is thinking about in order to boost the efficiency and participation from the foreigner into our market. And the implication of that will be mind-boggling as well. If China A, this is an exercise not done by us, but by MSCI itself last year. If China A is included in the MSCI emerging market indices, it will represent 13% of the index. Together with the China H that nowadays we have, 17%, China would represent roughly 30%, 30, of the MSCI emerging market indices. That is the point where international investor can no longer afford to ignore the China market, I guess. And this is why for long-term investors like yourselves, I strongly would argue that you start to position for this kind of changes. Given with the Hong Kong Shanghai Connect, I would have high hope that it will be much easier for international investors to gain access to this market. And with that, I believe international index providers like FTSE, MSCI, S&P, they will seriously consider the inclusion of China A into the market. This is another, because of the time constraint, I cannot talk too much, but I guess this is very interesting in the sense that if I show you these two charts, everybody knows the China Shanghai Composite Index has not been doing well. It peaked out at 6,000 points to the right-hand side at year 2007, and right now it is still hovering at around 2,000. On the other hand, what is happening on the red line? If I do not tell you about the index, you probably would think that is the S&P 500 index, but in fact that is not. That is the market cap of the China A-share markets in US dollar term. So this picture, we are talking about the same market. One is the market cap, the other is the index performance. The big divergence, I would say that everybody knows share price or index price times number of shares is the market cap. The reason for the underperformance of the China market in the last decade or so, I think is, last 5 years or so, is mainly because of the issuance of IPOs. But now these kind of changes are also being reversed. Part of the financial reform that is done by the CSRC, but I guess that will have some positive impact to the market. And going forward, I would expect this line, the index level, would catch up more with the overall market cap. Financial reform, one big thing of that is the SOE reform, where in the past, traditionally, SOE are very inefficient player. Another chart that I can show you is here, where the red line actually is the ROE of the private companies. They have been very stable in the past 10 years, at the range of 12 to 16%. So the private companies actually have done well in China in the past decade. The only part in the index, which is a big part, 70% of the index, not doing well is the SOE, where you can see the line coming down a lot. For obvious reasons, corruption, lack of efficiency, lack of incentives to the senior management. But this trend is also likely to change in the future as well, with a lot of reform plans like private-public participation, deleveraging, sale of assets. All these things have been starting since November last year with the new administration, new leaders coming to the market. And with that, we strongly believe that these black lines are more likely to catch up the red line going forward. And if your ROE can improve, I also believe that the price-to-book valuations of the overall market can also improve. Last but not least, I guess a lot of people ask me about my views on commodities, given I'm in Australia. You probably would know that since I have talked about the China property market, I do not expect a lot of growth on the infrastructure side. It will be more about market consolidation, market share gain. But on the other hand, this chart, I think, can share with you some of my view that China, on the other hand, they are also pursuing a theme called Beautiful China, where they will use a lot more renewable energy. So within the capital goods or the infrastructure spending, I would pay more emphasis in the area like solar energy and also nuclear and wind energy, where they're expected to continue to grow at 20 to 40% in the next few years, where the demand for coal, I expect, will be quite low at around 1% only. And there will be some big implication on the inflation outlook in China as well. Why the coal prices has come down so much in the last few years? At the peak, it was trading at more than 800 renminbi per ton at the Qinhuangdao port. Now it has come down to below 500. One reason for that, of course, is the lack of demand due to this Beautiful China and slowdown in investment. The other major reason is because of the logistic improvement. A lot of the coal, China actually do not lack coal, but they do not have enough coal in the consuming area, in the coastal area. What they have done in the past few years, they built up a lot of infrastructure in terms of railway lines and high voltage electricity transmission line to the coastal area. And this is why the coal prices are so depressed. That actually shared a similar feeling that I have in the US market. In the US, that was more because of the shale gas discovery, helped drive down inflation despite quantitative easing. In the case of China, it's more about the logistic improvement that will continue to drive down inflation. And this is my view going forward. Inflation in China will be more likely in the range of 3 to 4%, and the days of 6-7% inflation will be behind us. That is very important, given in other emerging markets of similar GDP per capita, you will not see any other emerging markets that will have such a low inflation rate. Now, going back to what I have said at the beginning, I know a lot of people concerned about China. Hopefully, on the banking sector and the property sector, hopefully I help address some of these concerns. And the other thing is regarding the investment in China. I know a lot of people like to buy overseas securities, but for me, I think if you want to play the SOE reform, if you want to play the through chain, the direct investment, Hong Kong, Shanghai Connect, you probably would like to consider some direct investment into the Chinese equities market as well.